Hello. Today we're going to talk about selling bonds. So if a company sells bonds, they're trying to raise cash. They sell bonds to the open market, just like you would buy stocks. So the first instance, we're going to talk about three different ways that we can sell bonds. We can sell them at par, which means we're selling them at face value. We could sell them at a discount, which means that we're giving the customer or whoever buys the bond a discount. So if it's a $250,000 bond, we might sell it for $240,000. And then there are times where we'll sell our bonds at a premium. In this case, if the bond was face value is $250,000, we might sell it for $260,000. So the very first instance we're going to talk about is selling at par, selling at face value. So the instance says a company issues bonds with a par value of $250,000 that matures in 5 years. So it's a $250,000 bond. It's going to mature in 5 years, and it pays 4% interest that's paid semi-annually. So that means the interest, the 4% interest is paid twice a year, on June 30th and December 31st. The bonds are sold at par or at face value on January 1st, 2013. How much interest will the company pay to the bondholders every 6 months? So the interest rate that's given is an annual interest rate. If we're actually paying the interest twice a year, that's really going to be a 2% payout. So that by the time they get both payments, it'll be 4%. Does that make sense? Okay, so in order to calculate how much they're going to get, it's going to be the face value, $250,000, times the 4%, times 0.5, because they're only going to get half of it in June and they're going to get half of it in December. So every 6 months they're going to pay out $5,000. $5,000 on June 30th and $5,000 on December 31st. That's what they're legally obligated to pay, because the bond certificate is a legal document. Okay. What journal entry will the company have to record at the bond's issuance? So at the bond's issuance, whoever buys it from us is going to give us cash, right? So we always record the asset first, and it's going to be $250,000. They're going to pay us the actual face value of the bond. And then we're saying in 5 years, we're going to give them all that $250,000 back, plus twice a year, we're going to give them 4% interest. So we need this cash for some reason. Maybe we're expanding our facilities or something like that, okay? So we're going to put a liability on our books, and it's going to be called bonds payable. $250,000. So we've got oops, not 25, 250. So we've got an asset on our books and a liability on our books. We debited one, credited the other. All right. Then the next journal entry is prepare the journal entry that would be done on June 30th when we pay our first semi-annual interest payment. All right. So we're paying out, we've already figured out it's going to be $5,000, right? Bond interest expense, or it could just be interest expense, just depending on how your company records that. $5,000. And we're paying it, right? Anytime we pay something out, it's going to come out of our cash. 5,000, oh, not 50. I keep putting one too many or one too little. Okay? And you'd put your interest calculation right there. We already did it up there. The $250,000 times 4% times 1/2, or 6/12, 6 months. Okay, so that'll be the journal entry every June 30th and every December 31st for the next 5 years when we pay that $5,000 out. Okay? Then what happens 5 years down the road when we have to pay that $250,000 principal back to the bondholders? Well, that bonds payable has to come off of our books, right? Because now we're no longer going to owe them. The bonds are maturing. So we need to remove that payable from our books, the $250,000, in order to reduce the liability. You have to debit it. And we're paying it, right? So our cash is going to be reduced. We just needed the cash for 5 years, and then we're going to pay them back. Okay? Very simple transaction when the bonds are sold at par value. So at issuance, we record the cash coming into the business, and we put the liability on our books, because in 5 years we're going to have to give them back their principal. Twice a year for the next 5 years, we're going to record the $5,000 that they get. Okay? And then 5 years down the road, we're going to pay them their money back. So we have to take that liability off our books and take the cash off our books. And that's it when you sell it at par value.